Hey traders! Welcome back to Pioneer Pips and Profits. In today's video, we're diving into how to use leading economic releases to forecast upcoming market trends. If you've ever wondered how to predict the direction of the economy before the big data drops, this one's for you. Let's get into it. So, what exactly are leading economic releases? These are forward-looking indicators that give us a sneak peek into what's coming in the economy. Think of them as early signals, like a weather forecast before the storm hits. Examples include Purchasing Managers Index, Consumer Confidence Index, Jobless Claims, Building Permits, Durable Goods Orders. These indicators often predict the direction of bigger economic reports, like GDP, inflation, or unemployment. Now, economic data can be broken down into three categories. Leading indicators. These predict future trends. For example, PMI shows potential growth or contraction. Coincident indicators. These reflect the current state of the economy, like GDP or employment data. Lagging indicators. These confirm trends that have already happened, such as wage growth or consumer price index. The key takeaway? By tracking leading indicators, we can get a jump on upcoming market moves. PMI, Purchasing Managers Index. PMI is like a pulse check on the economy, showing whether the manufacturing and service sectors are expanding or contracting. A PMI above 50 means expansion, often predicting growth in GDP and industrial production. A PMI below 50 signals contraction, suggesting weaker economic data ahead. Consumer Confidence Index, CCI. This index measures how optimistic consumers are about the economy. A high CCI means consumers are confident, leading to increased spending and higher GDP growth. A low CCI suggests people might hold back on spending, which could impact retail sales and economic growth. Jobless Claims. Jobless claims tell us about the strength of the labor market. A drop in jobless claims is usually a good sign, predicting strong non-farm payrolls data. Rising claims, on the other hand, could point to economic slowdown and higher unemployment. Building permits. Building permits give us a glimpse into future construction activity, which is a big part of GDP. Rising permits signal stronger economic activity. Falling permits can suggest weaker economic growth ahead. Durable Goods Orders. This one tracks new orders for goods that last a long time, like machinery and vehicles. An increase signals robust industrial production and business investment. A decrease might indicate weaker manufacturing activity in the future. So, how do you use these indicators to forecast future market moves? Understand the correlations. For example, a rise in PMI could forecast GDP growth. Monitor trends. Watch how leading indicators change over time to predict upcoming economic shifts. Use composite indexes. Combine indicators like the leading economic index for a broader outlook. Analyze market sentiment. See how the market reacts to actual data versus expectations. Factor in the lag. Leading indicators often precede lagging indicators by months. Timing is key. Use econometric models. You can even incorporate these indicators into models to forecast specific data like retail sales or inflation. Let's look at a few real-world examples. In 2021, the US ISM manufacturing PMI was above 60 for several months, which predicted strong GDP growth in the following quarters. A sharp drop in US jobless claims in late 2020 predicted a strong rebound in the labor market, which we saw reflected in NFP data. Of course, there are some challenges. False signals can happen, especially in volatile times. Data revisions can change how useful leading indicators are. Lag time variability means predictions aren't always perfect. External factors like geopolitics or unexpected policy changes can mess with the data. To make the most out of leading indicators, combine multiple indicators for a clearer picture. Adjust for market expectations. Understand how actual data compares to forecasts. Incorporate qualitative analysis. Political events or central bank speeches can give extra context. And always stay updated. Leading indicators can change quickly, so keep an eye on them. To wrap up, leading economic releases are powerful tools for forecasting the future direction of the economy. By understanding the relationships between indicators and how to use them in your trading strategy, you can stay ahead of the curve. But remember, no system is perfect. Always combine multiple data points and stay flexible. Thanks for watching. Don't forget to like, subscribe, and hit the bell icon for more insights on Forex trading. See you next time at Pioneer Pips and Profits.